Good evening, everyone. Without wasting any further time, we are going to start our second panel discussion for today. That is about passive investing. This session will remain active till 5 p.m. We are trying to incorporate most of the without any further delay, I extend my warm welcome to panelists and audience, and now I introduce to panelists for today. We have with us Mr. Nilesh Shah, who is a group president and the managing director of Kotak Mahindra Asset Management Company Limited. He has over 25 years of experience in capital markets and has held leadership over the Access Capital, ICICI Financial Asset Management, Franklin Temple, and ICICI Securities. Sir, we welcome you to our third session conference. I now introduce Neeraj Chokshi. Mr. Neeraj Chokshi is a co-founder and promoter of Angel Group of Companies. He is presently working in the capacity of joint managing director in the holding company. He is acting as a chairman of the recently set up asset management business and also acting as a director in NG Capital Private Limited. Sir, welcome to our third NISM conference. And now introduce our next panelist, Arnaud. Mr. Arnaud is the managing director of Amundi Asset Management, in charge of ETF, indexing, and smart beta business line. He has 20 years of experience in capital markets, from cash equity to derivatives trading. Mr. Arnaud has been a member of the executive committee of Lexer Asset Management and Wealth and Asset Management Unit of Société Générale in Paris. As head of the Lexer ETF division since 2013. Sir, welcome to third NISM. Let me now introduce to the session moderator, Monika Halan. Monika Halan is a trusted personal finance writer, speaker, and author who helps families to get their money decision right. She is the founder of the Untitled Chapter Financial Education and the best-selling author of Let's Talk Money. She is an adjunct professor with the National Institute of Securities Market and an Indian Institute of Corporate Affairs, a Ministry of Corporate Affairs think tank. Madam, welcome to the session, and now I hand over session to you. Thank you.
Thank you. I hope I'm audible.
Yes.
Okay, wonderful. Thank you so much. Thank you for the invitation. And the topic, I think, is something which is very, very topical and hotly debated for a variety of reasons. And as we get into it, I would have run the panel a little differently if it was only an India panel, because the Indian passive market is very different than the global. But I'll come to the Indian story right at the end. But I'm going to start with a slightly wider lens. And we've seen that there's been a massive switch towards passive from active over the last few years. The biggest firm ended 21 with a $10 trillion passive AUM, with the industry size topping $25 trillion AUM. A PwC study is predicting 25% of the total AUM by 2025 to be in passive. So there is this whole, and we've seen a mirror image switching from active to passive. When you look at the data charts, there is an outflow from active and inflow into passive. Now, some leading financial sector experts are saying that the risk-reward advantage of passive versus active investing is not infinite. The risk-reward advantage of passive versus active investing is not infinite. I would like the three panelists to make their opening comments reacting to this. Nilesh, let me start with you, and then Arnaud, and then Neeraj.
So, thank you, NISM, for inviting me over here. As Monika, you mentioned, there is a shift globally from active fund management to passive. And this is probably driven more by alpha generation of active funds. If you continue to underperform benchmark index, then it is logical that investors will try to replicate or invest into index funds. Obviously, innovator like Vanguard, by launching very low-cost index funds, ETFs, have facilitated this movement. In India, also, we believe there will be space for both active as well as passive. As long as fund managers are able to generate alpha and justify the fees they are charging, they'll be able to get investors' allocation in active funds. And when fund managers fail to generate alpha, investors will move towards passive funds.
Arnaud, coming to you, I want to specifically speak about this statement that the risk reward trade-off is not infinite in passive. So, specifically to that, Nilesh, a quick comment from you, and then I'll move to, I think Arnaud is frozen. Arnaud, are you there? I thought you were frozen. Nilesh, a quick comment.
Monika, could you hear me?
Yes, I can. So I will just wait for Nilesh to comment on the specific statement and then come to you, Arnaud, in just 1 minute.
Sure. So, Monika, the question about passive investing is who will benchmark the benchmark indices. In the Indian context, we have seen many a times even the big or main indices, including companies which were not necessarily having best governance, or companies which entered into indices at a much higher valuation. So clearly, the risk-reward ratio in passive investment is not infinite. When you are taking a call for investing in benchmark index, you still have to be sure how indices are constructed, how they are maintained, and how are they going to generate return in future.
Okay, so we'll open up the benchmark discussion just in a bit, but Arnaud, opening statements on this question of risk reward on passive not being infinite.
Yes, I hope you hear me well.
Yes.
Could you hear me well, Monika? Okay,
yes.
Thank you very much.
Yes,
thank
Arnaud,
you very much.
I pronouncing your name correct? Arnaud Llinas?
Yes, my name is Arnaud Llinas. I have the pleasure to be with you today. I'm heading the index and ETF business for Amundi. Your question about risk reward, I think the first point is to mention that the price of index passive management has decreased significantly over the last years. So it is effectively more difficult for active management due to the fees they charge to get alpha on top index management. So it's really, for me, first of all, a competition in terms of price of asset management, active versus passive, and probably passive is putting a bit of pressure on all industry to reduce costs. If we now look into every asset class, it really depends, meaning that on asset class like US stocks, it is now well accepted that it is very difficult to generate alpha on top of, I would say, S&P 500 large cap. We have internally studied the alpha generated by active managers, and this alpha could be found in, I would say, more niche market like small cap. If I take the example of the US stocks, you will see that active managers manage to get alpha when they try to beat the Russell 1000, which is mid cap and small cap in the US. All in all, question of fees and question of knowledge of the underlying markets. On top of it, maybe we're going to discuss it later. The advantage of ETF is to give price discovery intraday. And we've seen that during past crises, during the credit crisis in 2020. And I have to say that this morning, obviously, due to the events in Eastern Europe, we're going to see if index and ETF give price discovery in this very difficult moment. Back to you, Monika.
Yes, Arnaud, we'll come back to this price discovery because there is a view on the other side, but I'm going to wait for Neeraj Chokshi to make opening statements on this passive versus active and not having, unlimited advantage because of the volume.
Yeah, thank you, NISM, and thank you, Monika. I think one cannot generalize, that is what I feel, because generally the risk reward is measured in terms of Sharpe ratio. Now, going forward, I mean, we have seen data, particularly on the large cap indices, that more and more a number of funds have not been able to outperform them. And not only in terms of absolute performance, but on a risk adjusted basis also. Having said that, one cannot generalize, but particularly if you look at data, even S&P is coming out with data on Indian mutual funds with various indices, and particularly on the smaller and mid cap, there are still more number of funds which are outperforming those benchmark. So again, what is the benchmark now these days? We have, apart from cap weighted indices, there are equal weighted indices and several other things which has evolved over a period of time. So it would be very, very difficult for one to probably answer or make a general comment. But again, I mean, from it depends that what kind of index it is and what is the kind of portfolio construction one is making. And from a like-to-like basis, it has, as a general trend, we have seen that it is becoming more and more difficult to beat the benchmark, and particularly on the large cap side, on the equity side.
Right. So this is really where the conversation is going towards, where some of the financial sector stars are beginning to say that if the entire market is doing passive, then where is the price discovery going to be? And I'm going to take a few examples here. So New York-based hedge fund manager Ted Seeds, who lost $1 million in a bet with Warren Buffett, he lost that in 2017. And he said in a book last year that he would still make a bet were he back in 2007, things may have played out differently. He deeply believes in active fund management. He is a hedge fund manager. Peter Lynch, the famous Fidelity fund manager who gave a 29% CAGR for straight 13 years, has recently said that this move to passive is a mistake. I'm quoting, this move to passive is a mistake. People are missing the boat. Buffett, who's been a big supporter of passive for the non-specialist investor, is asking the question, would you treat your heart disease yourself or take the help of a heart specialist? Lynch is saying that he would pick the heart surgeon in the top quartile of the profession. Now, if we are looking at these examples, so the way that I'm seeing it is that we are talking of two different passive conversations. One is at an entry level where we are saying that for the uninformed retail investor, this possibly is the right first product to get. And the second is a more, it's an institutional investor who's rushing into passive. Arnaud, would you like to comment on some of these, the tension between what Buffett says and stands by and what experts like Lynch have said?
Thank you, Monika. First of all, we at figures, effectively, passive investing does represent now 20% of the asset management industry. That has grown over the last 5 years by 5%. It used to be 15%. So we cannot say that the market is controlled by passive. It's not true. The expectation in the growth for passive management for the next is 9% per year, which is a good figure, but which is not extremely high. So I think that the price discovery mechanism, obviously actors are playing, is still in place. That is a false accusation to say that passive management is already too big. Is not the case. Or on top of it, I would like to say that the diversification in terms of indices in the industry is very high, meaning that you can now found on passive, you can found sectors, you can find smart beta, you can find a lot of different strategies that actually are playing their role in terms of price discovery. Okay, so or worth mentioning that main clients are actually active managers that are taking bets, that are taking asset allocation decision by using ETF and index funds.
Right.
The granularity of ETFs gives a capacity to contribute to the price discovery. Now, coming back to the comment of Warren Buffett, it is that probably for the non-specialist investors, the choice of passive is a good average choice. Obviously, if you are a professional asset managers, you have the ability to monitor precisely, the alpha generated by active managers. It's probably a case-by-case analysis that you will do depending on the asset class and your choice between passive, every asset class, every sectors to find the alpha. And that's what I see now in the industry, meaning fund managers using both active and passive, making their choice depending on ability to identify active managers that can generate alpha in the long run. That's not an easy task because we know that the alpha generation is meaning that a manager can create alpha 1 year and not create alpha the other year. So that's a professional job to select active and passive in a diversified assets portfolio. But that definitely, using index fund as a benchmark will in any case not be a wrong choice for me. That give you the market level, the market index, and you know that in the theory, Markowitz theory of portfolio management, the market portfolio is the index capital weighted portfolio. So that's a benchmark that you can be around to generate alpha depending on your capacity to find this alpha.
Right. Arnaud, your connection seems to be a little not good. We are getting your voice sometimes with a break. So I'm not sure if it's
I'm sorry about that, Monika. I'm best.
Yeah. Okay. Nilesh, now the way that I'm looking at this market is that it looks as if there are two kinds of passive markets. When I think of an average retail investor who doesn't really know stocks, she's tasting equity for the first time, we would recommend a broad market ETF or index fund, for instance, in India. But the minute we are now looking at smart beta, we're actually doing active in passive because of the way the indices are constructed. Do you think this is the way the market is now breaking up, that for the HNI and institutional investor, there is the active passive fund because you can construct any index that you want. And it can be as risky as you want. But
yes.
Tell me.
Yes, Monika, absolutely. We are seeing broad indices like, let's say, large cap, mid cap, small cap. We are seeing concentrated large cap, mid cap, small cap versus diversified large cap, mid cap, small cap. And then we are seeing smart beta indices across sectors, across themes, across quantitatives. Now, we believe mutual funds will try to launch as many indices as possible so that every space is covered. Second, today, all smart beta indices are based on publicly available information. There is no private smart beta indices run by my own algorithm. I believe over a period of time, regulator will open up for public smart beta indices as well as private smart beta indices. If my algo is working well, obviously, I will be able to keep expenses higher and charge fees. The real cream will be offering wrapper or solution product on the underlying ETFs stroke passive funds. Distributor like Neeraj will be able to launch their own solution oriented products. mutual fund per se will also launch solution-oriented product. I was told by one of the research article that one very large passive fund provider only has 4 funds: global debt, global equity, local equity. And in that combo, they create various solutions and offer to their investors at much higher prices. Their base products run at very, very competitive rates, but the wrapper, the solution which they offer to investors, allow them to make more money. So we will see this market expand in all format. There will be broad conservative indices or broad market indices and smart beta indices. There will be public market smart beta indices as well as private smart beta indices. There will be direct index funds, ETFs, and fund of funds, and also wrapper or solution-oriented funds, which is investing into underlying index and ETF funds. That's how I believe markets will evolve.
Right. Neeraj, the advantage that we see of ETFs, index funds over actively managed funds, as Arnaud said, is, it is really to do with the cost as well. But if you start, so let's assume that there is that entry-level investor who's doing a broad market index fund ETF at wafer-thin costs. But as the search for alpha becomes larger and you have constructed indices, will the cost of to the index provider, for instance, not start adding to the cost of the ETF? So it's a hypothetical question, and maybe after Neeraj, I know I'm wondering whether we will see an escalation in cost, because at some point that cost will kick in. So Neeraj, first you and then Arnaud, on this issue of cost even within the ETF world. You are on mute, Neeraj. You'll have to unmute your mic. Neeraj, you'll have to unmute your, yes.
Yeah, sorry. Now is okay?
Yes.
Am I audible? Yeah, sorry. So what I feel that with the advent of technology, now the smart beta and factor-based investing is becoming very, very popular. And one can run multiple algorithms to test the back testing and all. Because if you look at the history, then the capital asset pricing model, which was talking only about systematic risk, and after that a lot of research has followed, and one of the most popular is the Fama-French research, which says that apart from systematic risk, there are other price determinants also. He was talking about the value effect and the size effect, and after that there has been a whole evolution of several factors now. So I guess, yes, there is a merit, and when you look at data over long periods of time, and again, most of the indices, the traditional indices, are cap-weighted indices. Now, there are certain analysis, certain research paper available which says that equal weighted indices over long period of time have outperformed the cap-weighted indices. So even on a Nifty, I just do a equal weighted Nifty index instead of a cap-weighted. It has a merit in outperforming over long periods of time. So it is basically, one will have to invest in technology, one have to be robust on creating risk-adjusted portfolios, or based on the preference of a customer. There are going to be various class of customers who may need, there is a person who wants higher return, a momentum kind of a portfolio can be created, and so on and so forth. So I think, as Nilesh bhai very rightly said, that if your strategy, if you have been able to create portfolios where you are able to generate a better return, because at the end of the day, it is not the cost which will matter to an investor. What is he earning? I mean, what the asset manager or the investment manager is earning, that least bothers to him. If he is getting an index at a 0.01 basis points, and against that someone is charging him say 0.5 or 0.75 basis points, but if they are delivering him a higher return, I think that cost doesn't matter. And particularly if we talk about the retail in consumers, I don't see that cost has been more of a concern. It is more about how the funds are performing. So I think, and probably on a risk adjusted basis, how the funds have been doing, I think that is going to be the key thing. And that's where I think the investment managers will have to invest heavily into technologies, into data. Data is a very, very big challenge. You need to do the data very well, because data is available, but it is scattered, it is not proper. So I think these are the things where it is going to be extremely critical and important, and that's where the investment managers will make a difference, when will have edge over other investment managers.
Right. So Arnaud, I'm coming to you with a question that we are looking at two kinds of passive markets for an entry-level investor with wafer-thin costs on a broad market index, and then the targeted ETFs where indices may be constructed. So would it be true to say that we might see cost escalation, the advantage that ETFs have had? Do you think there would be a risk of losing that advantage as you start seeing more specialized indices coming into the market? Because look, index providers also charge. So on a pro rata basis, it might not be much, but in the financial sector, costs start padding up.
With Neeraj, the cost of indices does represent only a few basis points. The competition between various index providers and the size of passive asset managers now growing gives us a capacity to negotiate with index managers, index providers, to negotiate. Or whether we shall be careful on two things. First of all, the index management business tends to be more and more a few big index providers. So we shall be careful, and I guess the regulators are careful about the capacity to maintain a competition between index providers. So that the competition can play its role in terms of price. The second risk I see is the emergence of ESG data. As you know, ESG indices, ESG investments is a new trend in the market. We've seen in Europe last year, half of ETF new money came into ESG. Those indices are much more complex in terms of data. And it's true that all data provider on ESG, I mean, almost all of them have been bought by index provider. So these data are more complex, much more costly to manage. So that's an additional cost on our side. So that's why we are negotiating with index providers, and we have developed internally at Amundi a capacity to create our own data set on ESG, so that if necessary, we can use our own data rather than using index providers' data. A last comment, maybe, I think it has been quoted in the discussion, the emergence of the US, where effectively you get rid of the index license, where you offer the client the capacity to create his own index, basically. So you transfer the price of the index from the index provider to the data index solution that a company may create. That's a trend we shall look at. Direct credit in the US. It has not arrived yet in Asia, in India, or in Europe, but that could be an additional pressure to index providers to reduce the costs.
Right. So it's sounding like some kind of a PMS in passive way. I can create my index and then get somebody to offer it in the market. So I want to now just turn we have 10 minutes and then we open for questions. I want to turn the conversation towards India, and we are still in the early stages of a larger passive market. A large part, which is in the ETFs, is coming through institutional money. Retail investor is not yet that much. So there is a movement towards index funds on the large cap side, but that is still very small. Arnaud, I'm still going to ask you this question, that You've seen the global trends in terms of passive emerging as a retail investor choice. I'm not here talking of the institutional or the very high net worth investor, but pure retail investors. What are some of the regulatory steps do you think a regulator can do to promote passive investing? Again, for a pure retail investor who's coming for the big bus indices on the broad market at thin costs and long-term sort of stability of return over the long term. Anything the regulators can do?
Thank you, Monika. I'm not sure that regulation is the first area to push retail investment. I will talk about the European markets. For me, it's more a question of education, financial education to the public, and a question of distribution. If this education, and that's our role to increase education toward retail, and for retail clients, to manage their own money, especially for retirement. If the retirement system is retail to take care of their finance themselves, meaning getting out, I would say, the state-owned retirement system, that will push clients to use and more investment directly funds, and probably they will use index and ETF because it is simple. So really depending on the evolution of the retirement system, more retail use those kind of instruments. The second element for me is a question of technology. If you give access to retail clients an easy to understand on your own, to manage money, to transfer easily your money into a diversified basket of investment funds that correspond to your risk return appetite, it's easy to do. That will propel this investment and this industry toward the retail market. And I can see that it's happening already in India, where the technology available for retail is already at a significant pace. We've seen that in the US with various robo-advisors. We've seen that as well in Europe. And what is interesting, you can see that big banks like JP Morgan in the US or UBS are buying those robo-advisors because they buy the technology. They want to offer to their retail clients a digital experience that is easy to manipulate and easy to understand. So I think this movement will help, I would say, the clients to take finance more than any regulation in the world.
Okay. Neeraj, if I can ask you this question, that for the non-advised retail investor, what is it that the regulator could do to promote a broad-based passive investing road? Because we have seen that the industry, of course, is selling, so are the distributors, the active, simply because of the larger costs embedded in the product. So what is it what can happen in the market that the early investors who are just tasting equity get pushed, get nudged towards something, and the industry gets nudged towards offering it a little better?
So basically, if we look at US is one of the markets where retail actually has been participating in indices, passive funds or ETFs. It's a RIA dominated market because RIAs are basically charging most of the investors, and that is how the emergence has taken place in US. Having said that, in India also the regulations are already there for RIAs. Yes, it will take some time. We'll need technology through which the RIAs would be in a position to service the customers in a better way. They can collect the fees in an efficient manner. I think that is one of the key drivers for getting a retail investor, because whatever you say, ultimately to a retail investor, that trust and that conversation with an individual is a huge, it makes a huge difference. The execution everything would be digital, but that is where I think the difference is there. And second thing is index funds are there for a distribution, which is a large distribution, where the cost may be slightly higher than the ETFs. Now that may not matter in a big way to a retail investor, but there is a possibility that gradually the index funds, with the spreading of education, the index funds would be sold by several distributors also. They can create asset allocation wrappers and offer, like we also do in some of our products, where we give them the choice of investing into active as well as into the passive, where you offer index funds, which is very far simpler to do an SIP. Now India is like a SIP market. To do a SIP and an ETF is extremely difficult, but in an index fund, it hardly matters to a retail investor whether to put in an ETF or an index fund. He doesn't need to time on a daily basis. So I think these are the steps. Of course,
Right.
as of now,
But
it is
here,
dominated by.
Because you're mentioning index funds and ETFs together, in India, we have a problem with liquidity. I mean, you go to sell even Nifty B's 100 and you need to wait a week. There is no depth in the market. So what are we talking about? I mean, there is no ETF depth.
Yeah. So the challenge here is that in other countries, the APs are creating, they are purchasing the stocks, and against that, they get the units. So the unit creation process is slightly difficult today for an institutional investor or a authorized participant. He has to make a payment first to the AMC, and then AMC will do the basket order, and that's how that investment has to be done. So if we want to, reach that, there has to be a netting mechanism which should be made available to the authorized participant. So then,
and this is the job of the AMC or regulator. Who should be doing this?
So I think it has to be a industry-led initiative with the obviously the regulatory
Somebody
some changes.
Like AMC, the
association and the regulations have to be made some changes, so that the liquidity and some schemes should be given to the market makers, liquidity enhancement program and all. And if all those things will happen, then definitely liquidity will come in the ETF segment also.
Right. Okay, so one question, Nilesh, to you, and then Arnaud. Will we see an Uber, Airbnb, Google kind of market emerging in ETF? Because, and I'm speaking specifically because we've got a new player in the Indian market who is doing very wafer thin costs. So you can gather the investors in AUM initially with very, very tiny costs, and you grow. So you become at a certain size, nobody can compete with you. So Nilesh, do you think, at least in India, and then Arnaud, I'm going to ask you the same question looking at the world, that will we see this, the winner takes all model even in the ETF market, Nilesh?
So undoubtedly in ETF market, in our experience, early mover has a big advantage. Now, early mover could be in terms of cost, as you mentioned, or it could also be in terms of execution. We have seen many index funds have very high tracking error for a variety of reasons. Now, you may have a very low cost but high tracking error fund. You might as well prefer a little higher cost but low tracking error fund. So there will be opportunity for fund managers, even in passive strategy, to create a differentiation. And in my opinion, our ability to create differentiation through private beta indices, through lower tracking error, will be equally important compared to the cost.
Okay. So Arnaud, in terms of a global view on this question, that do we see this Airbnb, Uber winner takes all model, or as Nilesh is saying, we will see specialized offerings with smart beta and the other parts of the market?
I think on the main indices, the benchmark indices like S&P 500, MSCI Europe, Nifty, the price will go down, and eventually this market will be controlled by a few ETF issuer, something like 5 out eventually. That will be able to lower the costs because of their size. On top of that, the creativity and the innovation in that space is so high that we can see every day a new ETF issuer coming in. For instance, on the thematic indices, the megatrends ETFs, see in the US, in Europe, in Asia, small boutique that will propose their investment philosophy, their intellect based in the index and potentially through an ETF. So there will be two markets. There will be the market of the big blue chip indices controlled by a few that have the capacity, to offer investment at below 5 bips total expense ratio. But you will see at the same time a lot of innovation at a higher price. And just coming back to a comment of Neeraj and Nilesh, effectively the market can develop on the retail space in any other country only if there is a proper mechanism of liquidity transmission between market makers or authorized participants and the asset manager. And this liquidity transmission mechanism is only available if you have a regulatory environment that enable the APs create and share very easily at the end of the day with the asset manager. So that's a prerequisite for, I would say, for the success of ETF.
So Arnaud, you're saying that, sorry to interrupt, you're saying that there is some regulatory intervention needed to provide liquidity. Is that what I'm hearing? And what would that be if that is correct?
No, mechanism on index regulation, on fund regulation, a mechanism that enable the market makers, the authorized participants, to create easily at the end of the day at the net asset value. That's what I call the liquidity transmission between the primary market, which is on the asset manager, and the secondary market, which functioning thanks to market makers. Right. So this mechanism need a specific regulation to enable this transmission liquidity to be efficient.
Okay, so I'm going to ask one personal question to each of you and then open up for questions from the audience. Neeraj, I'm going to ask you first, if you had to choose active or passive, you cannot tell me I'll do both. You have to choose in your personal investments, active or passive.
I think smart beta is a better option.
So passive.
Passive.
Okay, Arnaud, your personal money.
Unfortunately, Monika, I have a lot of time. So when I don't have time, I buy an index fund because it's in average a good bet when you don't have time.
Yes. Nilesh?
Well, I have trusted my fund managers. I have never invested in passive funds till now.
Okay, wonderful. I've got a few questions here, and in case the anchor will like to ask some more. There is Shrikesh Bhatt asking if passively managed index funds are doing well. Does it mean actively managed funds are not doing well? If basically, I think the real question is that why are people shifting? So if I can understand the thought behind the question is that, Nilesh, you want to take this, why are people wanting to shift towards passive?
So, of course, majority of people shift because active has not added value and passive seems to be a better bet because of lower cost. But in the Indian context, passive funds have been built up because there is allocation by institutional investors like Employees Provident Fund Organization only in index funds and ETFs. They can't invest in active funds. So it's not that Indian active funds are not adding value. Of course, their value addition has come down over the years. But because of statutory requirement, also many a times allocation happens to passive funds.
Right. Okay, let me just take the next question. Any of the other panelists want to take a shot at this question? That, is it that active funds are not doing well? Why this move towards passive?
Maybe one comment, Monika.
Yes.
I think depending on the volatility regime, effectively when you have a market which is bullish and driven by technology, especially in the US with the Nasdaq, etc. It's very hard, I guess, for active manager to perform. But if the market environment is getting more volatile and more diverse in terms of sectors, and we see that beginning of this year, active managers will have the capacity to generate alpha. So for me, it really depends on the market environment you are evolving.
Okay, so we have a question from Venkatesh. He's saying, with only 250 to 300 well-researched companies, are we in India too early to go for index funds? Neeraj is making the point that the liquidity, breadth, depth is we're still, though it's work in progress. So is it still too early to go index ETF in India?
So first of all, passive is not only ETF. If we are talking about retail, even if you invest in an index fund, it is passive. I think same. Now, with already the penetration has been extremely low in terms of whatever numbers you see, GDP to mutual funds and whatever compared to the Western world. I think index fund has a merit, particularly for the new entrants, and definitely that market is going to take place. It is just started before a few years. As of now, it is more of the institutional money to ensure that the liquidity is there, and we will see those things happening. Recent regulation has come that if you want to say ETF, it is going to be a fast ticket kind of a thing. And more, the more education which is going to prevail active side, because it is a predominantly active fund management industry. Now with new players entering who has a core focus on this part, I think that activity also will start and it is going to evolve. It may take a few years. I don't know how many, but yes, definitely it has started. That's what I feel.
Okay. All right. I'm going to pass it back to the anchor at NISM in case the audience there has some live questions.
Yeah, I received some questions, but I doubt whether we can address all of it. Start with this first question. How does passive investing contribute to necessary market volatility?
Just say that again. It was not very clear. How does passive investing
contributing to necessary market volatility?
Does it contribute to market volatility?
Yeah.
Okay. Arnaud, did you get the question?
Yeah. No. My thinking is obviously you can have, I would say, crowdy investments, and effectively ETF gave access to markets more. But my thinking is this access to liquidity actually contributes more efficiently to the price discovery. When we looked at previous actually the capacity to trade intraday through ETF was a way to tackle more efficiently any crisis. You basically distribute the risk all of the day and through many more actors than in a classic mutual funds. So for me, the fact that those elements are listed give the capacity to take liquidity crisis and to recover for liquidity crisis much more efficiently.
Okay, I would now like to go with the conclusion of the session with the permission of the moderator, because considering the time constraint, we won't be able to address all the questions. So I'm going forward. On behalf of SEBI NISM conference, I take all the panelists, Nilesh, Shah, Neeraj, Chokshi, and Arnaud, and the session moderator, Monika, Halan. Thank you so much for being a part of us in this conference.